looks like we're at 1 o'clock here, so we'll get things started. First of all, thanks to everyone for joining us here today. I'm Matt Murphy. I'm the Vice President of Commercial Banking here at IBIS World. Today I'm joined by John Madigan, who's one of our product analysts, as well as Jim Furman, who is our Client Services Manager here in Commercial Banking at IBIS World. Today's webinar is titled Industry Exit Rates, How to Identify Lending Opportunities versus Risks. This is actually a webinar we decided to host to piggyback off of an article that John actually published for us earlier this month. Don't worry if you haven't read that article. John's going to kind of do a bit of a highlight reel for us from some of the stats and findings that he had put into that article, but we'll also be sending a link to that article out after the fact to all attendees, a recording of this webinar along with the slide deck that you're going to see, so stay tuned for that after the fact. In essence, what we'll be doing today is just firstly kicking things over to John, who is essentially going to just take us through some of the economic findings that he had from that article that he published. Essentially what we've seen over the course of the pandemic is that certain business sizes have been affected more than others within the economy. So certain industries and business sizes that underwriters and credit teams may want to look out for. But on the flip side to that, certain opportunities for lenders to take advantage of in different industries that have been more resilient than others, and certain business sizes that have been more resilient than others. So he's going to talk about some of the implications for banks in particular. He's then going to kick things over to Jim, who's going to take us through IBIS World segment benchmarking tool, where we're tracking different business sizes as well as the industry entry and exit rates, or business closures within certain industries, something that we've added to our database based on requests from a lot of our banking and credit union clients. And then we'll cap things off with a offer to trial our segment benchmarking tool for any bank or credit union on the line that doesn't already subscribe to our segment benchmarking tool. We will be more than happy to give you a free trial period of that. So there will be a poll at the end that you can answer if you are in fact interested in trialing that. We'll get to as many questions as we can. Just know that we're going to try to keep things to about 30 minutes. So if we don't get to your question, don't worry, we'll also follow up on any questions via email after the fact as well. Based on the registrations, it looks like we have a lot of folks joining us that are current IBIS World subscribers, which is great. Maybe also, though, a few folks that aren't as familiar with IBIS World. So for anyone that doesn't currently subscribe to IBIS World, a little background: we're essentially the largest provider of industry-level data and risk ratings for a little over 500 banks and credit unions in the United States. We cover 1,400 plus different industries these days. So on the business development side, lenders are using us to identify industries in need of capital. They're looking at our industry reports to prepare more industry-specific pitches and presentations for their clients, and more or less position themselves as industry experts when they're meeting with clients in a wide variety of industries. And on the credit side, we're used heavily by underwriters when just looking at things like industry benchmarks, industry financial ratios, and trying to determine whether a particular client might be outperforming or potentially underperforming its peers within that industry. We also provide risk ratings that help them hopefully mitigate any credit risk associated with industry factors along the way. Now, during the pandemic, we added COVID-19 impact statements to all of our industry reports. We also created a local data tool and a COVID-19 impact tool to help us understand how things like state and local regulations are impacting different industries, social distancing, supply chain trends, how those are impacting a lot of different industries, and actually led us to create more state and local information within our industry reports. So traditionally, we've looked at industries at the national level, but now helping lenders and credit analysts to look at how industries are behaving at the state level, as well as the county level now too, which is something we've gotten a ton of great feedback on. One of these other questions that started coming up during the pandemic that John is going to touch on a little bit when he talks about business sizes is a need from bankers to better understand how they can get a like-for-like comparison between their client and similar businesses. We had a lot of bankers tell us that they don't want to compare the revenue growth, for instance, of a small business owner to that of a large corporation in the same industry. It's just not a fair comparison. So before we launch into some stuff about segment benchmarking, I'm going to launch a poll here for the group. I'm curious to hear what this audience thinks, whether or not your institution currently takes into account the size of a business when determining whether that's a good deal or a business that the institution wants to do business with. So You'll see a poll pop up here on your screen. There's a few different options to choose from. So you can say that yes, your institution looks at the business's size on every single deal. You can say yes, you do, but only on larger or more complex deals, or perfectly fine as well. If you don't currently take that into account, we definitely want to hear that as well. All right, seeing that looks like a pretty wide majority is taking that into account on each deal, looks like, and then a few that are maybe, considering it only when dealing with larger, more complex deals. I asked that question just because it's something that seems to be more and more important. I'll close the poll out and we can start talking a little bit more about some of those business sizes. But actually, I can share this here so you can see what everyone had to say there. I bring this up because it is something, like I said, we've been hearing more and more about. But looking at our segment benchmarking tool is something that we've also gotten a ton of great feedback on. So if we look at this screen here, you can all see that. We should be able to see now. Let's see. There we go, our segment benchmarking tool. And really what this does is it's able to break down industries based on a couple different factors. Firstly, we look at employee size, but also we'll look at the revenue size of a business. That way you can kind of compartmentalize your clients into their different sizes and look at statistics that are not just looking at the industry as a whole, but looking at how things are behaving for other businesses within that particular business size, more or less, that like-for-like comparison that we talked about. We'll also provide a SWOT analysis for each business size. So, certain industries or certain business sizes within certain industries will have certain strengths based on the size of their business. Smaller businesses might be able to be more agile, larger businesses might have more resources. And then lastly, we have our industry entry and exit rates. That's really going to help us determine within a given year how many businesses are opening within that given industry and how many industries are potentially closing within that industry. Now, this is not a proxy for defaults within the industry necessarily, but it can certainly give you an understanding as to whether more businesses of that size are closing in that industry in a given year, or if it's actually net growing over the course of the year. And these are really some of the statistics that John used when he was looking at industries that are potentially at risk given things like supply chain issues, labor shortages, and stuff like that, but also other industries that are seeing a boom right now, and more particularly business sizes that are seeing a boom right now. So that being said, I'm going to kick things over to John, and he's going to talk a little bit about some of the research he did for this article.
Thanks, Matt. I appreciate it. Good morning to those who are on the West Coast, and good afternoon to those who are on the East Coast. I appreciate you joining us today. So when we consider bankability of firms and companies, we'd like to look at the operating environment first. So let's consider inflation. That has been up about 5 to 7% this year, depending on your metric. You can see in the graph on the right-hand side here. We should be considering supply chain constraints with shortages of shipping containers, blockages at ports, and difficulty using wholesale, excuse me, and difficulty using wholesale drivers to distribute goods from ports. That feeds directly into other issues such as labor issues, and more particularly, there's a bit of a labor shortage ongoing right now. And more importantly, there is rising uncertainty within the Omicron surge. So we take all of that into account and also consider a potential rate hike from the Federal Reserve in 2022. And in summary, we have an operating environment in which inflation erodes consumer spending power, supply chain and labor shortage cause excess price distortion, uncertainty causes spending to lock up, and a rate increase, generally taps the brakes on the economy and makes things more difficult for those who have variable rate debt. Broadly speaking, this is not a great time to be a business owner or to be an operator really across the economy, but the good news is that there are performers out there, and IBIS World segment benchmarking and business location drill down tools can actually help you find those clients. So how do we do this? We have a tenet that company size matters, that operating sector matters, and that location of operations matters. So when considering these three things holistically, you will be able to find bankable clients regardless of industry, and operating sector, they are there, but hopefully our tools can help you to uncover them. On the next slide, we can see company sizes. On the next slide, there we are. So in blue, you can see the 1 to 49 employee segment. In red, the 50 to 500 employee segment, and then in black dots, the 500 plus employees. So initially the pandemic started, and then through about August of 2020, we can see that there has been an increase in deviation from the historical share of firms closed by size. So the pandemic caused firms to close. However, we do know that the pandemic caused a net establishment creation. And that's where you see after August with these lines dipping below the zero, saying that we have a lower share that has been historically closed. However, in the larger companies, 500 plus, you see it's dipped and then trended back towards zero. That is really the efficient market occurring as it does, in which these larger companies with larger financial resources, balance sheets to lean on, brand recognition, they close operating locations in unprofitable areas, open new locations in profitable areas, and thus trends back towards a steady number of establishments. However, you can see that there has been a net formation of small businesses, and that number has been trending downwards from the historical average, meaning there's more establishments open. However, in December, January of 2020 and 2021, we see the labor issues, supply chain issues sort of seeping in to these smaller companies and slowing things down a bit. That's where you can see the spike back towards zero, slowing new business formation down. On the next slide, you can see that operating sector actually has a very big impact on whether a company or operator was closed or not. So in blue, you can see the percentage of establishments closed during Q2 2020. In red, you can see the percentage of establishments closed historically on average between 2015 and 2019. And in black, you can see the maximum percentage of establishments closed during the Great Recession. It's quite apparent that other services, leisure and hospitality, retail, trade, transportation and warehousing, and particularly economy-wide on average, we have shown excess establishment closures than we exhibited during the Great Recession. So obviously other services, leisure and hospitality, those are very consumer-facing industries. And due to the considerations explained in the first slide, we can see why more establishments would close there than perhaps in another sector such as construction, which actually did not do quite as bad as you might have expected compared to the Great Recession. More importantly, you can see labor issues seeping into retail, trade, more really transportation and warehousing, in that those also have been compounding supply chain and inflation issues. Now, on the next slide, we can see the share of estimated permanent exits by sector, measured between the period of March 2020 and February 2021. Obviously, we can see in blue that the pandemic has caused excess establishment closure in almost all observed sectors. However, we know for a fact that other services has been extremely impacted, and also accommodation and food services. So the tenet in that your size and operating sector will help determine bankability is also informed by the location of your company. On the next slide, we can see a bit of an example here about how location matters. And here in blue on the left, you have the percent of temporarily closed restaurants in New York City versus the percent of temporarily closed restaurants in Oklahoma in red. Obviously, the population differences of these states would lead one to believe that there's going to be a higher percent share closed in New York than in Oklahoma. However, these graphs do well to indicate that there is a difference in the distribution of economic shutdowns, efforts to contain the virus, stay-at-home orders, and you can see how that really has an impact on the operating activity in the graph on the right, in which we see the cumulative percent of establishments permanently closed within the restaurant sector. So as you can see, Oklahoma is relatively flat, whereas New York City keeps accelerating for about a year as they get worse and worse. So again, the location of your client or the loanee is going to make a very big difference in whether they have maintained operation throughout the pandemic, whether things could become more difficult for them should Omicron surge worse. But overall, at the end of the day, size, location, and operating sector are some of the largest determinants in a client's bankability. So on the next slide, we can go to a bit of a more familiar example. So this is the segment benchmarking for the auto mechanics in the United States. This is, a familiar story. Everyone knows the pandemic hit. You drove your car less. There were travel restrictions. We were working from home. We wanted to stop the spread. So clearly not a great time to be an auto mechanic in the fact that demand had been significantly reduced. On the other hand, though, there were individuals who certainly used their vehicles and drove around and took advantage of those empty highways. So as a result, there in fact were mechanics that did see demand. However, how do we tell who they are? Which mechanics were performers and which ones were lead balloons? So as we can see here, as expected, the larger operators did fairly well during the pandemic, and we expect their market share within the industry to increase over the next 5 years, whereas most others are decreasing. However, since not everybody can make loans to the largest clients in a space, as Jim might allude to in a little bit, you can also notice that the 10 to 19 employee segment has actually been performing well and is expected to increase its size of the total industry. Therefore, that represents a population of bankable clients who are expected to increase their performance while all others are really not doing so well. However, I think now is probably a good time to turn things over to Jim so he can walk you through, and we'll do a bit of an example of segment benchmarking. Thank you, everyone.
Awesome. Thanks very much, John, and thanks everybody for joining us today. I think it's helpful to start with a story, again, like John said, we could all relate to. So we all know an example of an industry or industries that are kind of dominated by the largest companies. Software has Microsoft, coffee has Starbucks, and it's companies like Starbucks and Microsoft that are driving these industries forward with innovation and making an inviting marketplace for smaller and mid-size companies to operate. And while companies of all sizes, they're going to set up shop in the same neighborhoods and generally speaking, offer similar goods and services, they're going to face unique challenges based on their profiles. So from a financial and operational standpoint, these small and medium-sized businesses in the industry, they're going to look to everybody that's in attendance today for some sort of guidance. And without the same centers of influence that these large companies might employ, small and mid-market companies are going to need to work closely with their banking partners to help them understand their competitive position versus other companies in their industry, versus other companies their size, and even in their backyard. So what John had mentioned, the importance of size, sector, and location when determining a customer's bankability, IBIS World solves for X, Y, and Z in this equation. And so for the rest of today's overview, what we'll look at are IBIS World solutions. First being the business locations drill down, and second being the segment benchmarking tool. All right, and so now what we're looking at is the My IBIS World for Banking homepage. If you are familiar with IBIS World, you know this page well. If you're new to the site or not a subscriber to IBIS World yet, IBIS World, we've been working with banks and credit unions since our inception 50 years ago. And during that time, we've built banking specific tools. We've worked closely with our banking partners to figure out best practices. And so everything you see around this homepage to help familiarize yourself with the site is there with our banks and credit unions in mind. So feel free to, at your next login, or ask your relationship manager to help guide you through what some of these links describe. Also, what you'll see in the middle of the page is that we've created through this My IBIS World for Banking a nice workflow through each of the three main uses of IBIS World, being our lending view, our underwriting view, and our credit risk view. So within each report now, you'll find a role-specific view that speaks specifically to folks in more of a lending capacity, more sales-focused questions. Underwriting will provide information about our risk information, risk scoring, whereas the credit risk speaks more to the broad portfolio and how to monitor risk once those loans are populated in the portfolio. Also, Matt had mentioned earlier our coverage. IBIS World publishes nearly 1,500 different industry reports. Those are split across 2 collections, and I'll just show you quickly what those look like. So the first is our NAICS collection, and I'll scroll through how we map everything out. Really, in the NAICS, we map and report generally at the 5th digit of NAICS, and all of those reports will roll up into a specific sector. You'll see how they're listed out on the screen: agricultural, mining, utilities, nice and easy to find. And again, in the NAICS collection, over 700 titles. Over to our specialized reports. In a similar way, you'll see how the industries are mapped out and grouped into specific sectors. This is a growing collection, so now it's about 750 titles, but we do add as we identify new niche or emerging industries that are being introduced to the market. So 2 places to look to, really, to help support no matter what kind of commercial clients walking through your door. We have the information and the trends to help have intelligent conversations, and once those relationships are built, to help underwrite those loans. As for the example of what we'll go through today, we'll look at John's auto mechanic report. And so searching for a report, very simple. You can either use a keyword search, or if you have the associated NAICS code, you can go ahead and search. We'll find auto mechanics in the drop down here, and we'll jump into the report. Now, as for the key areas that we cover and the problems we have solved in that equation of size, sector, and location, we'll start with location. What we'll look at first is the business locations drill down, and this is available to all of our banking and credit union partners. It can be found within any report under the lending view. And about 2/3 down the page, we'll find ourselves with this business locations map. Now, with the business locations map, it gives you the ability really to easily compare industry averages, and with more of a local footprint in mind, we can drill down from the national to the state and even to the county level. And so if it's part of a prospecting conversation, or you're trying to expand existing business, this is also helpful when writing up credit applications for more of those regional or local based companies. You'll see that we provide 4 key metrics on revenue, employment, establishments, and wages. And as we drill down into this industry, let's use Texas as the example. You'll notice the information below changes. So now this industry becomes a $4.2 billion industry within Texas. There are 6,000 businesses, and you could also find information on employment and wages. If we want to take it one step deeper and go all the way into the county level, that's also possible. And so you'll see that this industry now is a $417 million industry with 589 businesses. So a nice way to dive deep into the industry based on geography and tailor to the conversation you want to have with your customer. The second piece, and what solves for the remaining pieces of the equation, size and sector, we now also provide the segment benchmarking tool. So at the very last chapter of each report, if you were to subscribe to the segment benchmarking tool, you'll be able to learn more about how different segments of this industry are operating. And we base this off of employee size. So while this loads up, I'll give a bit more of a briefing. We look at, and important to consider, size and sector. Through some of the graphs that John provided, we know that some goods industries fared better during the pandemic. They were able to pivot towards more of an e-commerce setup, whereas some of the service industries, auto mechanics being included in that, were maybe more adversely affected. But we want to look more specifically at how maybe different business sizes within this industry were impacted. The segment benchmarking tool helps with that. First, we'll start off with a market share spread of the percentage of revenue that's taken up by each of these different segments. So you'll see it's a good spread between small and medium-sized businesses here. Also, when looking at the performance of overall sectors, again, going back to the goods and services example, on the surface, auto mechanics might be and look like a bit of a riskier industry given the times, but we'll notice that there's still bankable segments within this industry. So we can see this 10 to 19 employee segment, identifying it as an increasing segment of the market. And with the other segments around it, maybe more of in a credit or risk sense, seeing that they're decreasing, this could be an action item to follow up with the customers you know who operate in these segments and have a conversation around what sort of challenges they might be facing and how you can best support them. But we'll use the 10 to 19 employee segment for the rest of today's example. And it's really nice. You can just click to scroll right into this segment. Now, everything we see for the rest of this will be specific to this 10 to 19 employee segment. And so we're looking at $11.2 billion generated by companies of this size. There's about 18,000 different businesses that operate within this segment. And you can see the rest of the data listed out. Down a bit further, we'll start to cover the SWOT analysis. And so Matt alluded to earlier, bigger companies have the opportunity maybe to close less profitable locations and open up in more productive areas. Smaller companies maybe need to be more creative. Naturally, they're going to face different challenges. And so the SWOT analysis will speak to those opportunities and threats that you may want to discuss. In those earlier conversations, when you're doing some financial planning and acting as that trusted advisor, you could present some of these opportunities that a customer or prospect might be seeing on the horizon. Whereas some of the weaknesses and threats they might want to keep in mind, you might want to keep tabs on moving forward. But again, these will be different for each segment. Under the performance benchmarking, so what we're looking at here is growth in general. So across key areas like revenue and employees and establishments, we're looking really at the growth within each of these areas. One of the new and exciting metrics, especially helpful for banks when working with small and medium-sized companies, is this entry and exit rate. And so this is looking at whether businesses are either opening or closing in this segment. And it can act as a great key risk indicator in the case that maybe a small, medium, or newer business to the industry doesn't necessarily have the predictability or the historical financials to dig into and predict. So we've seen this being used as that KRI to help support lending decisions. How you determine whether this is a net entry or a net exit is taking the difference between the exit and entry rate to determine whether, again, there's more businesses either opening or closing within this segment. And then down to productivity benchmarking. So now, whereas we looked at how effectively companies within the segment are growing, within productivity, we're looking at now how effectively they're reallocating that revenue across their organizations. And so you'll see things like revenue per employee, employees per establishment, and average wages. But a new and exciting metric that we also provide with the segment benchmarking tool is expansion and contraction. So what we're really taking a look at here is either the growth or decline in labor force for this segment. And what we mean by expansion is that a company within the 10 to 19 employee segment is either growing into our next largest segment or decreasing down to the 5 to 9 employee segment, for instance. So it's a good kind of barometer of whether or not there's expected growth and are companies in a position to hire and move into these new segments. The final area is really raw data. So nice, neat table of both historical and forecasted trends and figures, revenue, establishments, wages. This chart, knowing that many of you will be working out of Excel, is very easily exportable into Excel, as is the full report. In fact, the full report is available in Word or PDF as well. So just something to keep in mind more from a feature and sharing aspect. those are some ways that you can download and use for yourself. So that rounds out the business locations tool and the segment benchmarking. And with that, I'll pass it back to Matt for some closing remarks.
Thanks, Jim. Appreciate that. I think it's important to note, to follow up what Jim just said as far as downloads and things like that go. If you are already using IBIS World, you probably already know this, but if you don't, you can always feel free to download parts of our reports, screenshots. If you're a lender, use it as a leave behind with clients. If you're a credit analyst, incorporate any of our analysis into your credit memos. Feel free to do so. We like to think of ourselves as a time-saving tool just as much as anything else. While we're still looking at segment benchmarking, though, I'll throw up that second poll that I mentioned earlier. And if anyone on the line, whether you're a current subscriber to IBIS World or not, if you want to take this segment benchmarking tool that we've just released for a test drive, just respond to this poll. We can definitely have your relationship manager reach out to you and follow up with a trial period so that you can play around with it a little bit, use it with some real world client meetings, use it with some real world credit memos. And in the meantime, we'll try to address a few questions. I know that we're kind of hitting the 30-minute mark. So again, if we don't get to your question, don't worry. We'll have your relationship manager also follow up via email. So if I just pull it up. Jim, I think the first question might be best suited for you. We got a question. Does the segment tool have private company information, and where do you get this information from?
Sure. So everyone's looking for private company information, right? Especially in the smaller segments, the 0 to 4 and upward. The tool absolutely includes private company information as well as public. This comes from the Census Bureau, more specifically the survey of U.S. businesses. And so that's where we're pulling it from. If you read through the census, you'll see that they segment their company sizes the same as we do. And so again, to recap, yes, private company information definitely available from the survey of U.S. businesses.
Awesome, thanks, Jim. This question here is the small business tool. I think we're referring to the segment benchmarking tool, open for us to use now. Just to take it back to the poll, feel free to answer the poll if you are interested in it. We will definitely have your relationship manager reach out. We have a lot of banks and credit unions subscribing already, and if your bank is one of them, we'll make sure to let you know that as well. Another one here, John, I think this is probably more in your wheelhouse. How will Omicron continue to impact business output from your perspective? What factors should our bank keep an eye on moving forward?
Yeah, sure. That's a really great question. And ultimately, anything when it comes down to, the expansion or contraction of COVID cases and the impact on the economy, the only real answer we have for sure is we don't know. However, there is good and bad speculation, and speculating as to what Omicron may do is really unhelpful. However, we can consider that if things don't improve, the operating environment is likely to remain tight. Labor will likely remain short, and inflation will probably continue to go upwards. However, if we are looking for something that we can bank on a little more in the future, it is that the Federal Reserve has become much more hawkish on inflation, and they've said that they may raise rates up to at least 3 times this year. So no one's sure when or by how much, but there is pretty strong indicators that would lead one to believe that it is in fact going to happen. So rather than be on the lookout for what may or may not happen with Omicron, it's probably much more useful to focus on the fact that rates will be going up this year. Thank you.
I think it's important to note too, this is all through the backdrop of a year in which, I think a lot of folks are anticipating increased volume in commercial lending. I know there was a recent PayPal survey that said that more than 1 in 3 business owners, small business owners, I should say, anticipate applying for a loan in this calendar year. There was an article from American Banker earlier this week with a lot of quotes from chiefs over at Huntington, Fifth Third, Mercantile Bank as well, talking about how excited they are about the prospects for commercial lending this year. So with that volume going up, more important than ever for lenders to be looking for those ripe opportunities within industries that are poised for growth, business sizes within those industries that are poised for growth, and then of course taking into consideration the geographic location of those operators as well. So yeah, it's very important to keep that up, and of course take that into account, credit quality of those businesses. Well, Jim, I appreciate you taking us through the tool there, John. We'll have folks send your article after the fact. I appreciate everyone joining us here today. I hope everyone takes care. Thank you.
Thank you.